Can you actually afford a $40,000 car in Canada on a $60,000 salary? Welcome to today's explainer. I am so excited about this one because we're going to do some serious napkin math right now. We're going to break down one of the most common financial traps people fall into and exactly how to reverse it. Grab a coffee, get focused, because we are diving straight into the $40,000 car trap.
So, let's just ask the big question right up front. Can you actually afford it? Society tells us yes. The dealership, well, they definitely tell us yes. But we aren't listening to them today. We are looking exclusively at the math. And to really do that, we got to completely strip away the illusion of your gross salary.
Which brings us to Section 1, your real take-home pay. Because the truth is, you don't actually earn $60,000. You earn whatever the government decides to leave you after they take their cut. Let's break this down using the latest 2025 and 2026 Canadian tax brackets. Step 1, sure, you start with a gross income of $60,000. But Step 2, federal tax. The base federal rate sits at 14.5%. Then, Step 3, provincial taxes, which average out to roughly 5.05% depending on exactly where you live. When you crunch those numbers, the picture looks incredibly different than that big $60K number implies.
Here's the stark reality. After federal and provincial taxes, your actual net monthly take-home pay is roughly $3,950. That's it. That is the actual cash hitting your bank account every month. That's what you have to live on, pay rent with, buy groceries with, and, as we're about to see, pay for your car with. All right, moving to Section 2, the car alone trap.
Let's set up a highly realistic scenario here. You're buying a shiny new $40,000 car. You've been diligently saving up, you survive all the dealership upsells, and you actually put $10,000 down in cash. Nice job, but that still leaves you with a $30,000 auto loan to finance. Sounds perfectly normal, right? Well, the real danger is in the interest.
Based on recent data, the average auto loan rate for new loans is around 6.5%. But if you walk into a major bank like TD, RBC, or Scotiabank, they're starting prime borrowers at closer to 7.2%. So, just to be completely realistic for our napkin math today, let's assume you secure a flat 7% interest rate over a standard 5-year term.
And here is the crucial point. A $30,000 loan at 7% interest spread out over 5 years equals a massive monthly payment of $593. Let that sink in. Every single month, for 60 months, almost $600 just vanishes from your account.
And here is why that is so incredibly dangerous to your budget. Think back to our real take-home pay calculation. That $593 payment? That means a staggering 15% of your net income is completely swallowed up by a single, depreciating piece of metal. Before you've paid rent or bought food or paid for heating, 15% of your hard work is just gone, tied up in a liability sitting out in your driveway.
Okay, Section 3, the $10,000 alternative.
We have reached the ultimate financial fork in the road. On one side, you've got the status quo, the $40,000 financed car that literally chains down your cash flow for 5 years. But on the other side, the alternative, buying a reliable $10,000 used car in cash. You own it free and clear. And because you have absolutely zero car payments, you can take that exact same $593 every month and invest it. You are putting your money to work for you instead of working for your car.
Let's look at Section 4, the power of investing.
We really need to know exactly what that monthly cash could do if you unleashed it into the market. Well, according to a century of data from AGF Investments, the S&P/TSX Composite Index, which is basically the broad Canadian stock market, has delivered an average annual return of 7.55% over the last 100 years. Just think about that. Through recessions, booms, busts, the market has reliably grown wealth over the long term.
When you map out those historical annual returns, it's pretty eye-opening. Yes, you get negative years. The market dips roughly a third of the time. But look at the overwhelming sea of positive years. Time and time again, the data shows that in negative years frequently followed by double-digit returns. So while volatility absolutely exists, for sure, the long-term trajectory is this incredibly powerful upward force. Moving into Section 5, building real wealth.
Let's do the exact math on our alternative path. Step 1, you faithfully invest that $593 every single month. Step 2, we apply that historical 7.55% annual average return. And Step 3, we let the absolute magic of compound interest take over for the exact same 5-year time frame you would have been paying off that car loan.
Think about these two financial realities side by side. If you took the loan, in 5 years you own a rapidly depreciating vehicle. You've bled cash to interest, and your asset is worth a fraction of what you paid for it. But on the flip side, you get the exponential upward growth of a consistent investment portfolio.
By simply choosing to drive a reliable $10,000 used car and investing your monthly car payment, after 5 short years, you would have over $43,000 sitting in the bank. $43,045 to be exact. Instead of owning a depreciating liability, you've literally built yourself a massive financial safety net.
And that leads us perfectly to the core takeaway of this entire explainer. Stop buying liabilities. Start building wealth. Now that we've mapped out the true mathematical cost of the $40,000 car trap right here, what are you going to choose to do with your next paycheck? Thanks so much for joining me today, and keep making those smart choices.